Hi, I'm Doug Carroll from InsidersGuideToFinance.com with a video for you today on short sales. Now, what's a short sale? Well, there is a more technical definition, but a good working definition is a sale of securities not owned. Now, for those of you not familiar with short selling or financial markets more generally, that surely might sound somehow fraudulent or manipulative. But as we'll see, there are many good reasons why one might consider shorting securities. And in fact, it's a transaction that would be encountered in many different walks of commerce. In fact, I suspect many of you watching this video have been buyers of short sales without even knowing it. Ever walk into a car dealership to buy a car and actually sign the sales contract, but you didn't want one of the cars on the lot? You liked one of the models, but you wanted a different color car and you wanted the upgraded stereo system. What did the auto dealer say? Oh, I don't have that one in stock. You'll have to take your business elsewhere. Almost certainly no. The auto dealer or salesman had that sales contract out and was filling out and had you sign on the dotted line before you left. Guess what? You were just a buyer in a short sale. The dealer sold you a car he or she didn't own with the intention of fulfilling your order by buying one from the factory or a local distributor. Or ever buy a electric range or refrigerator and not roll that out on a hand truck or have an employee of the dealer roll it out for you? Well, guess what? If you didn't walk out with it like that, you probably were just a buyer in a short sale. So let's put it more in the context of the financial markets, which is, I presume, most of the audience for these videos. Why would someone sell short, and exactly what is a short sale in more context or detail? Well, you can think of a short sale as like buying low and selling high, but in reverse. Most of the time when people are thinking about investments, they think in terms of buying at a relatively low price. And let's say one can buy some stock or a bond at 84. And they're hoping that sometime later they'll be able to sell it at a higher price, like 96. Well, if I could buy at 84 today and sell at 96 at some point later, I'd realize that 12-point gain is a profit. But what happens if, when one is surveying the universe of possible investments, you don't see anything you think is relatively undervalued? All you can identify are securities that seem to be relatively overvalued. Well, it doesn't mean there's no opportunities in the market. It's just that you can do the reverse of the normal sequence. Let's say when I look around, all I see are investments I think are overvalued, and so maybe today I sell at 96. If at some later date I could buy that back at 84, I'm still making that 12-point difference as a profit. However, the short sale is admittedly a little bit more complicated, because when you sell short, when you sell something you don't own, the buyer on the other side of the transaction is typically not buying to accommodate your desire to go short. They're buying because they wish to possess the security. The buyer in the short sale wants to own the security long as an investment. Or perchance the buyer in the transaction had written an uncovered call previously and they got an exercise notice. So they needed to obtain those securities to deliver on the exercise of that call. There's other possibilities, but that should make the case. Since the buyer of the short sale is not buying to accommodate the seller's desire to go short, that means the short seller has to come up with the securities from someplace. And believe it or not, in many instances, it's not that difficult to get securities to deliver on the short sale. Most large fixed income institutional investors will run a securities loan program where they'll lend securities out for any number of reasons as a way of generating additional return on their portfolio, because they can charge interest on that securities loan. Or that's the reason for the reverse repo market. In those transactions, the counterparties to the repo and reverse dealers are reversing in securities, again for any number of possible reasons, but in some cases that's to deliver on the short sale. And I didn't mean to imply from my earlier illustration that the only reason one would sell short is to speculate on the decline in some securities price. Shorting is actually a very common strategy that's undertaken to hedge other long exposure. For instance, mortgage-backed security dealers oftentimes short sell treasury securities as a way of hedging the risk of their mortgage-backed securities portfolios. So hopefully that lifts the cover a little bit on exactly what a short sale is and some of the motivations for doing them. But short sales are actually very common transactions for a wide variety of reasons. And aside from the benefit that's presumably obtained by the short seller, they make markets work more efficiently because the more ready buyers and sellers willing to participate in markets, the more efficient that market is likely to be because of the greater liquidity. I hope you enjoyed this video. You can go to our YouTube channel or Facebook page to see other videos on a range of investment-related topics. Or you can go to the website, insidersguidetofinance.com. At our website, in addition to the free video shorts, there are a series of modestly priced, in-depth training videos with running times of approximately 1 hour each that go into a number of subjects in greater detail. The website and Facebook page also contain information about open enrollment programs I will be presenting over the next few months and my recently released book, The Insider's Guide to Fixed Income Securities and Markets.